that's sponsored by the Women's Philanthropy Board, focused on where we are with the economy. Our theme for this year is navigating today's economy, preserving wealth and pursuing philanthropy. And we thought that if ever there was a time to have what we call an extra session, this would be it. Failed banking systems, stock markets around the world plunging, rising unemployment, a major credit crisis affecting home ownership and almost everything else you can think of. And if we ever doubted that we are living in an interdependent global economy, I think that that doubt has been thoroughly taken away. We're hearing people say that never have there been more trying times since the Great Depression. So the question is that true? How did it happen? What's coming next? When does all this end? And what can we do to preserve the wealth that we have accumulated? About 10 days ago, I was chatting with Sid James, who's the executive director of the Women's Philanthropy Board. And she was talking about the conversations that she'd been having with our members. And her comment was, we really need to get on this. If ever there's a time to say we need to meet the urgent needs that our membership have indicated, it's now. So this was our way of saying, maybe this can be our philanthropy. Let us do a session, open it to the public without charge, and hope that we'll do a public service favor for our community. We firmly believe that knowledge is power, and we have three very knowledgeable people here today who can help us unravel some of the complexities of this critical issue that we're dealing with. This session will only last a little over an hour, so I'm not going to go through all the bios of these individuals. They are in front of you, but let me just give you a snapshot of each of their backgrounds. Dr. Keivan Deravi is Special Assistant to the Chancellor and a Professor of Economics at Auburn University at Montgomery. He is the architect of the Alabama Economic Forecasting Model, which is used to generate forecasts for the state's major economic variables. Dr. Deravi's research focuses on the theory of monetary policy, foreign exchange markets, and regional economic modeling techniques. He has been quoted in the Wall Street Journal, London Financial Times, the New York Times, National Public Radio, just to name a few. Dave Dennis, to my immediate left, is president of Specialty Contractors and Associates, Inc. of Gulfport, Mississippi, a commercial and industrial subcontractor. He was appointed by the Board of Governors to the New Orleans Federal Reserve Board and served 3 full terms as chairman. Dave is a valued member of the Dean's Advisory Board in the College of Human Sciences, and Dave, thank you for being here today. Susan Moore has worked as financial planner and stockbroker for Wall Street investment firms for nearly 25 years. In 1991, she started her own practice by opening an office in Alexander City, Alabama, affiliating with the independent broker-dealer Raymond James Financial Services. In 2006, she adopted the name Moore Wealth Management, Inc. for her practice when she changed her independent broker-dealer affiliation to Linsco Private Ledger, the largest independent in the country. Susan is WPB corporate partner, and she co-chairs the Events and Networking Committee. I want to thank all 3 of you for being here, and Susan, I'm going to ask you if you would please moderate.
Is it working now? Okay, wonderful, wonderful. It's interesting that these events have played out the way that it was because Dave, Dennis, and I, and his wife Jane were on a trip that the Women's Philanthropy Board sponsored last October over in Italy. And at that point in time, the subprime situation had been deteriorating for several months. And I had been starting to read about trying to research for the benefit of my clients. And what I had been reading really, really concerned me because I knew that hedge funds existed, I knew that derivatives existed, but when I learned about the extent of leverage in the world that had been built up by the use of all these derivatives. To be blunt, it scared me silly. And so I'm sitting across the table at lunch and with Dave, and we have all these wonderful WPB members with us, and I started talking about how I'm concerned about global market meltdowns and major financial institutions going under, and all the women around the table are looking at me like I'm a crazy lady. And I'm asking Dave, what is, am I seeing demons behind bushes that aren't there, or what is the Fed doing about it? And that started a dialogue that we've had for the last year, and Dave very graciously came after the women's symposium in the spring when he spoke, came and spoke to my clients up in Alexander City, and they loved his speech about the Fed. So this was something that some of the experts did see coming and were writing about, and the fundamental cause of what we're going through right now is the extreme buildup of leverage that has happened in our global economies over the last several 10, 15, 20 years. And now we're paying the price for it. And so we're going to each talk about 10 minutes from our perspective of what is going on. And then we'll interact, and then we want to take questions. We want to leave a good bit, 20, 30 minutes so for questions, especially for the students in the audience. Dr. Deravi, let's start with you, okay?
Yes, ma'am, my pleasure. Let me go to the podium.
Okay.
I'm a teacher.
Okay.
I can't sit down and talk. Only the executives can sit down and talk. Ladies and gentlemen, it's a pleasure to be with you, and I got to share with you that over the last 2-3 weeks, I'm speeched out. I talked about this topic. I think I'm going to get really bored with the topic. Let me tell you where I'm coming from. Again, as I shared with you, I'm a teacher, but I have the distinct pleasure of working with a large group of influential people that they're not interested in my opinion. They just don't want to know what happens tomorrow. So I don't have this leverage of sitting on the fence and basically saying on one hand this and on the other hand other thing. Let me very quickly move on and share my opinion with you. I'm going to talk about a lot of issues. It's going to open a lot of questions that I probably will be able to address later on. When I was in graduate school, and that's probably about 100 years ago, there was a book which was a mandatory book for us to read in the macroeconomics, the second sequence of advanced macroeconomics. It was the book by John Maynard Keynes, who's the most famous economist, I think, that ever lived. And in chapter 22 of his book, which was the general theory of equilibrium, he talked about if the fundamentals are not there, how the market can collapse. And the banking situation may find themselves in a situation as we speak today. And he talked about the phenomenon called liquidity trap and how it may come about, meaning that the central bank will start pumping money in the system, but because of the fear of liquidity, the financial system may hold on to it and not passing on and sitting on to it, and basically talked about ineffectiveness of monetary policy, all of that mumbo jumbo, whatever it is. We read that and said, nah, it's not going to happen, no way. So it was just a chapter. Little did I know that chapter 22 is basically repeating itself. I had to actually go to the library and get that book because I just trashed mine, way back when. And read chapter 22 to see how it works. Listen, guys, we're talking about two phenomena. We're talking about, we got a situation that we have to address, and we are talking about the situation that we have to address for a long, long time. The liquidity crisis is here, and it had to be addressed, and it's going to be addressed in one way or another, in good shape, bad shape, ugly shape, it will be addressed. The Federal Reserve System, the Treasury, the United States government, and the entire Western world will throw whatever's necessary, the kitchen sink approach, to make it happen. Let me start with saying one thing that they've been repeating to everyone. Capitalism cannot exist without capital. Get it. And capital had to flow, had to move on. Banking system has a fantastic role to play, and the banking system had to come through the process. When I lecture in my classes, ladies and gentlemen, I just basically tell them that The economy is basically driven by two forces, in my opinion. One is rich people hire smart people to make money for them. Smart people are under pressure to be extremely competitive, live on the margin, make 1% here, have 1% there. They come up with innovations, they come up with schemes that no one else knows. And this innovative schemes runs the market. Second factor that runs the market is fear and greed. We are motivated by greed, and we run out of town because of fear. Now, smart people who are under pressure to make money, and greed basically overtook their ingenuity, and they pushed us to the level that we did not know it existed. And now we have to correct and go back to fundamentals. We have to talk about what happens tomorrow, figuratively speaking, meaning that what happens by Monday or next week for the market to calm down and the financial system to sell. But that's the short-sightedness. We have to talk about next year, 2 years from now, and what stores in there. About 2006, 2007, I advised the executive branch. We raised the flag and we told the governor that we are not subscribing to the view that everything is just absolutely peachy and hunky-dory. We said that we don't know what's going on and we don't know how deep it's going to fall, but we think that this cycle is basically overcooked. We told the governor exactly the word that they used was that price-earning ratio cannot support the fundamentals. There's 20% correction in the stock market that needs to be seen. We were counter-argued with us that, well, you have to look at sector by sector, and say, well, that's fine and dandy when you're looking at fundamentals that exist in terms of market. Let me tell you what we were motivated by. If we look at California, I always look at the state of California because it's a mirror image of the United States. California economy is 1.8 trillion, ladies and gentlemen. That's 1/5 of the US economy. California market is twice the size of India, and India is one of the most fascinating emerging market coming forward. We look at California, we saw all the excesses that was there. And we're still looking at California right now to see and learn what may happen to us. As we speak, California unemployment rate is about 7.7%. That's what probably we're looking at. The best case that we presented to the governor last year, in November of last year, was unemployment rate of about 5.7%. We have to go back and raise that estimate very, very severely for the next 3 years. Folks, when you look at the numbers, $72 billion was pulled out of the mutual funds and is being parked in money market funds. This happened this last month. This month, in the month of October, close to about $52 billion has been pulled out of the mutual funds and is parked in the money market funds, in the federally insured accounts. There's a lot of fear out there. There's tremendous amount of fear. Let's talk very briefly about, extremely briefly, how did it happen? Again, as I shared with you, there was a lot of ingenuity, a lot of pushing the envelope. I was talking to a reporter from Birmingham News, and we were going back and forth. He wanted me to be a gloom and doom and extremely negative, and I said, I'm not going to do that. So we went back and forth until we come up with a way to describe the scenario. And this is what we settled on. The economy can be resembled, or what happened in the market can be resembled as, you go to the payday loan, you get a loan, you go to the pawn shop to release the rented furniture that you pawned to raise money already. Meaning that we're talking about leveraging, we're talking about excesses all the way to the core of this economy. Folks, in about 2003, 2004, Fannie Mae decided that because of whatever reason, and we know, most of us know what that reason is, but for whatever reason, they have to concentrate on low-income housing and increase the housing rate, home ownership rate, for low-income citizens. Since about 2004, 70%, 50 to 70% of all the loans were targeted for that area. Now, Fannie Mae said they're going to buy all these loans, process it and send it forward. At least these are the estimates that's floating out there. If you do a simple numbers, let me do a number for you. Let's assume that this is roughly the same. There are about 100 million households. Let's assume that 70% home ownership is out there. That's about, and assume that about 120,000 average price of housing. There are about $9 trillion worth of mortgage loans out there. Roughly, again, roughly speaking. Assume that, and this is a fair assumption to make, that we raised home ownership from a historically stable number of about 59% to about 69%. So we raised the home ownership within 3 years by 10% over historic steady state rate. 10% is that push that Fannie Mae basically financed to get here. That's about $875 billion. Is it a surprise that the package is $700 billion? It's basically targeted at that. I have seen bad packages, but I have not seen as bad as the bailout. This is a desperate attempt to shore up the financial situation of the balance sheet of the banks. And all that it does swaps, bad asset for good asset. But I'm an economist. I teach about market clearing process, supply and demand. I tell everyone that market determines the price, not the Treasury, not the Secretary of Treasury, not whomever works for the Secretary of Treasury. There's going to be a guy who's going to be the king of the market, determines what assets should be changed, how it will be changed, what prices should hold. It would work. It would work. I'm not saying that it will not work. It will work. There will be hiccups. There will be a little a bump in the road here and there. It would work. But what I'm trying to tell you is fundamentals are still out there. What are the fundamentals? Saving is historically at historical rate. It's at 0%. Saving and investment, there is a relationship there that had been broken for a long, long time. When the federal government is running huge federal government budget deficit, it points to the capital inflow, which is basically got to come up from somewhere else. There is historical imbalances that have to be addressed. We have imbalances in the banking industry. We have imbalances in the airline industry. We have imbalances in the housing industry. We have imbalances in the consumer industry. Credit card debt is pretty much at a very high level. Expectations of the retail activities are pretty low for this coming holiday season. As a matter of fact, in September, credit usage has been dropped by about 5% for general merchandise product. The consumers are basically scared. They don't know where to go, what to do, how to do it. There's an enormous amount of destruction of wealth, close to about probably $8 trillion already in the market because of the market deflation that we have seen. Fundamentals still out there have to be addressed and will be addressed. No one is talking about a humongous amount of liquidity being injected in the system. How is it going to be withdrawn in an orderly fashion without creating some sort of inflation in the long run? There's a lot of questions that have to be addressed. But I'm going to stop here and sort of let the discussion start. My view is very different. My view is that this phenomenon, I take 2 aspirins and come back tomorrow, let's see if it's okay, it's not going to work out. We had, for about 20 years, we said things are not going the way that is according to some sort of dismal quasi-science we call economics. But it's here at this point in time. Again, we can talk about the bailout, we can talk about where the stock market may or may not go, we can talk about deleveraging the industrial complex from the commercial financial sector, which is by itself a humongous task to undertake. We can talk about all of those. But what we are looking right now, and I talk to people that I work with out of Global Insight in Boston and economy.com out of Philadelphia, folks that we work with them all the time. The best case scenario I can put in front of you is a decline in GDP of 3 quarters, starting this quarter, about 2%, going to next quarter in the second quarter of 2009. That's the best case scenario I can put in front of you, basically talking to people who forecast the macroeconomy. Worst case scenario that I can put in front of you, people are talking about maybe a slowdown in growth until the economy can find its own footing. That may last. I'm not talking recession, lasting that long, but sort of slowdown in economic growth. We come out of this recession, then we will experience about maybe 2% growth in the GDP or 1.5% growth in GDP until we can get rid of excesses everywhere for about 3 years. That's a tremendous adjustment that we have to make. Tremendous adjustment that we have to make. I just recently gave a speech to a group of board of directors of a bank, and they were very curiously about 2 days ago what I would think. What I think is a lot of factors that we got used to may not be here in about 10 years from now. There's going to be pressure on the state government to make a decision on what they can finance and how to finance it. We have retirees, we have healthcare issues, we have infrastructure, road, bridge issues, we have education at K through 12, we have education on higher education. It may come to the point, ladies and gentlemen, and I was talking to the governor's staff in the long run about this. It may come to the point that we will tell the higher education, raise the tuition. Go. We can't help you. It may come to the point that the education at the higher education would be only for very smart or very rich. Higher education for everyone is a birthright of Americans right now. We may have to revisit that and take a look at it. Simply because, again, some of the fundamentals that we're looking at least for the next 4 years, next 5 years, we're looking at how to juggle this ball. Now, there are 2 issues at hand. I'm just going to stop at this point. There are 2 issues at hand. There are 2 major issues. How to fix it quick, right now, how many additives and Tylenol we have to have in order to stop the pain, and then what happens after that? How do we address the rest of the issues? This is not something that happened overnight. This is something that was cooking for a long period of time and was accelerated since about 2003, 2004. And it's going to take a little while for it to be fixed and go forward. But I want to end with one story that I was told. And I have to tell you this story. Prime Minister Winston Churchill was famous for getting drunk and staying drunk for a long time. He was drunk in one of the dinner receptions, and a lady approached him and told him that, Mr. Prime Minister, shame on you, you're drunk. And Winston Churchill said, I know that, madam, and you're ugly. But tomorrow I'll be sober and you still be ugly. The point that I'm trying to make, that story stuck with me, and I know it's not politically correct, but that story stuck with me. The U.S. economy is the most efficient, the most productive, the greatest economy that exists. There's a reason that we are the keeper of the world economy because we can absorb all the monetary shocks and deflect it and keep the world economic order together. We may be drunk now, but whatever tomorrow is, we'll be sober and we'll be okay. It's one of those, the way that market works, in my opinion. Higher you go, faster you go, farther you fall. And that's where we are. Again, I'm just trying to give you a little bit of sort of my view of it. We come back and address any question that you may have. Thank you.
I'm going to sit here, so I'll have Susan as a safety blanket beside me if we get a little trouble. If it's been established we don't have to be politically correct, then I'm going to call things like I see them, which I think is probably what most people want to hear. Just very briefly about the Federal Reserve, I got paid $200 a month to be on that board. Chairman Greenspan had 3 regional appointments. I was one of his 3. So consequently, Jane and I would spend a lot of time with those folks. Ironically, 2 nights ago, we spent 3 hours with the head of one of the 4 legs of the Fed. I hadn't been on the board. I was term limited and went off in December. But the gentleman that's head of all of cash for the Fed, we spent about 3 hours with on Wednesday night with about 15 minutes notice. So I'm going to tell you the Fed knows exactly what they're doing. They have a very elastic balance sheet. And I'm going to touch briefly on liquidity versus solvency, on just generally credit in general, and really the aspects from probably a 10,000-foot look down as opposed to really penetrating with specifics and exactly from an accounting point of view and an economic point of view, specifics about it. So for the professors in here, probably we get a C on this paper. For lay folks, I'm going to try to address it. I did an op-ed piece for our paper a couple of days ago, and that's exactly where I tried to zero in. Let me tell you a little about the Fed. The Fed has a very elastic balance sheet, meaning when they go in and you see the rates, I guess 2 mornings ago, there was an orchestrated rate cut around the world, on the free markets around the world. It's not completely unprecedented, but it is incredibly unusual. There had been orchestrated plans like that before, but in terms of overnight just making a firm decision, this is what we're going to do, that is quite unusual. The way the Federal Reserve goes into a market and enhances liquidity, and liquidity is the big deal going on right now. They go in and they either dump bonds, you hear we're enhancing liquidity to putting this amount of money in. Well, Chairman Bernanke or previously Chairman Greenspan, they're not going to call up the head of Chase Manhattan or any other particular bank and say, all right guys, let's bump it down a quarter, let's bump it up a half. That doesn't happen. They physically, by supply and demand, go in and throw money into the market. If they want to lower rates, then they sell bonds into the market. It's supply and demand, and they track it to the tune of about a 1/100th to 1/1000th of a point on how the rates move. If they move too much off of a particular curve line, then they're going to either infuse or they're going to pull money out of the market. So if you want to lower rates and put liquidity in the market, which is what you're hearing so much about right now, the way they're doing that, they're selling bonds into the market. Well, with supply and demand, when you continue to put more supply in a market, that's going to drive prices down, and they know how much they need to put in to reach a certain target level. And the interest rates, they're not dictated, they're target rates, they're implied rates. And so the Fed puts money in. Now, at the point in time when they want to enhance rates or increase rates, they'll go in and buy bonds out of the market. Again, supply and demand. So the money supply constricts, money gets tighter, rates go up. So saying that is the format for how the money is infused into the market from a simplistic point of view is simply supply and demand. It's Eco 101. It's put money in, and you put money in by selling bonds into the market, let people buy them at whatever rate they want, flush out the market with more cash, pull it out. That is the foundation for what we're going to talk about. The liquidity versus solvency, that's what you're hearing about. You're hearing about liquidity in all the banks. Well, the banks, as you traditionally know them, most of the banks that we deal with, there are 2 kinds of banks. They're banks that the Federal Reserve would have regulatory control over, FDIC, insurance, other things. Then there are investment banks. The Goldman Sachs that you saw go down a few weeks ago, the Bear Stearns you saw go down in April, and ironically Susan asked me to come speak to her group, and that happened the day before, so that was really an intriguing comment. We talked about a bailout then, which I'll let you think what my conservative thoughts on that are. But as you look at investment banks, 2 different scenarios. Your normal bank here in Auburn, it's sound, it's leveraged. We talked about leverage earlier today. Leverage on a normal bank is anywhere from 8 to 12 to 1. So let's assume you have about a 10 to 1 leverage in a typical bank. That means you have about a 10% equity position. Your investment bankers were playing home run derby. They were out leveraging anywhere from 30 to 35 to 1. Some cases I've seen as high as 42 to 1. Well, what does that mean? That means if you're at a 35% or 35 to 1 leverage, you've got 3% equity in something. If you've got 3% equity in the price of, let's say, your chief equity asset, whether it's land, whether it's a house, whether it's some kind of tangible property, if it drops 3%, you're underwater. Well, that's what happened to the big boys on Wall Street. And it does affect every one of us. It affects everyone in this room. But as they were going through a market from about roughly 2002 to 2006 or 7, the market for subprime loans was fertile. It was incredibly fertile. And it came about, you can go back to 1978 for the Community Reinvestment Act. That was actually the genesis of it. It came into play. Then beginning as you went through the 90s, we had some extraordinary peaks and valleys in our economic arena in that particular decade. In 1998, oversight was lifted. 1998, not 2 weeks ago. 1998, oversight was lifted off of much of the Freddie Mac, Fannie Mae convergence of loans. Well, that basically let them make loans to people that no banker would make a loan to. No typical bank would make a loan. We all want people in serious housing, but not at the risk of bringing a total economy down. And candidly, that's not going to happen, but that's the bubble we've been on for the last probably 12 months, specifically invisible the last 2 to 3 months. Particularly, it manifested itself really in April with Bear Stearns, and then it was put on the shelf and people forgot about it for another 3 or 4 months. So the investment bankers, the guys that are leveraged 35 to 1, 30 to 1, they're in a subprime market. They are buying their money. Let's say they go out on the bond market, buy their money for 2%, and in effect sell it, if you will, via a mortgage for 8 or 9% that happens to be 2 or 3 points above market. They're making an inordinate profit, so yes, they are. They're making a heck of a profit. Your normal banks have what's called a compression rate, the rate between just your old accounting balance sheet, cost of goods sold versus cost of goods purchased. So the input cost for money in many of the mortgage arenas for a normal bank is going to be, particularly right now or in the past several months, probably 2%, let's say, and they make a loan for 6%. The investment guys were borrowing money from bondholders, from investors that wanted a premium, so they paid a little bit of a premium. Let's say they paid 3% and then loaned it out for anywhere from 7 to 9%. Not in a predatory type arena, but in an exponentially profitable arena. So they're making more money. They're in an area where it's fertile for exceptional profits in a rising market. Well, this is pretty much driven as a housing. If we have a major recession, and it appears that clearly that's likely what will happen, it's going to be a real estate driven recession. That's what's going to be the catalyst for what's going on. So these guys in a falling market, remember that 3% equity position they have, meaning their assets are 3% more than the cost of what they bought it for. Well, their assets drop 6%. Well, suddenly they're 3% underwater. They're not going to make it. And that's clearly what's happened. So it's almost been a rob Peter to pay Paul situation. So liquidity versus solvency. That's where the investment banks are. Your banks, your typical bank that you know and that you see and that you deal with, they are liquid. They are solvent. The Federal Reserve requires reserve ratios that are really very conservatively documented and conservatively calibrated. So you've got banks that are very solid. Don't worry about your account at your bank. Don't worry about your deposit at your bank. This is primarily a meltdown in stocks and equities that virtually every one of us in this room own, and if not, your parents do. So that's where we're coming in. Companies have an exceptional balance sheet. Again, accounting 101. Solvent, your balance sheet looks great, your income statement looks great, you don't have any scratch in your pocket, you can't pay your bills. You look good on paper. I'm sure Jay Jacobs would say there have been teams that look great on paper that didn't perform well. There are many companies that look great on paper that don't have the money to perform. That's what this liquidity crisis is. It's not having money in your pocket as a company. Now, what is that going to do? Where are you going to see it? Where is it going to pop up in our economy? Automobile dealerships are beginning to hemorrhage. Automobile manufacturers already are hemorrhaging. But your dealerships are going to see some very, very soft times. The industry we're in, construction, is going to be pretty tough. In fact, it candidly has been. But the underwriting standards at most banks have been tightened down significantly, meaning if you went in, let's say you wanted to buy a $100,000 piece of property, and typically they would loan you an 80% mortgage. You put $20,000 down, you borrow 80. Well, right now, most banks are taking that $100,000 appraisal, discounting it perhaps as much as to a 70% point, maybe 80%. So if you have a $100,000 appraisal and they discount it 70%, suddenly you have a 70% appraisal as far as your underwriting standards are concerned. And then if they loan you 70% of that 70% appraisal, you're basically going to be able to borrow 50% of an asset base. Now, that's not an absolute comment because there are many grade A customers that the banks deal with that have exceptional balance sheets. If they're liquid, they're exceptional long-term customers, they will look at each thing individually. But it's just simply going to be just an extraordinarily tight credit market, and that will affect a lot of things. It's not going to shut us down. It could shut us down if we fall off into the abyss, but clearly, I think you will hear from Susan, there are a lot of things that can be done. There are a lot of things that are being done, and I will give the Fed credit. They have reached out to past members. I chair their national directors, which Chairman Greenspan and I would swap spots in his office, which was pretty intriguing. But at the end of the day, you've got to perform, you got to have a basis for your operation, and you got to have cash in your pocket. Until liquidity starts flowing again, that's going to be a concern. I know that's a very simplistic approach, but I'm close to my timeline on what Susan allotted. She gave me a book a year ago called When Genius Fails. Now, I could take that either way. I'm not at that level. I assume you wanted me to at least understand what was going on. I did read it too, by the way. But When Genius Fails deals with, starting in the early 80s, the guys at MIT, many of your statistical and mathematical, I would just say geniuses that put together the derivatives, that put together what a lot of people call funny money on Wall Street. They put together instruments and vehicles of investment that were nothing more than paper instruments and vehicles of investment. They were predicated on certain market conditions. On shorts, when a market drops and you see people selling short, all that's really doing is sucking the market down more. Now, I'm not going to comment on whether that should happen or not. I do think in this environment, it's unhealthy. Your hedge funds, as a rule, are betting against your market. They're betting against you, and they're betting against really the success of this country. And there are a lot of people that would disagree with what I just said. But fundamentally, shorts and hedges have acted as a detriment. From my humble point of view, there are plenty of people that have made enormous amounts of money with them, and there are plenty of people that will adamantly disagree with what I just said. But in a very tedious, tender market, you need to go back to your basics, and you need to stay in the most simplistic common denominator you can operate in, that the lay people and the common rank and file people in the country understand. Because if you lose them, if you lose what people fundamentally understand and can grasp, it's going to really just open up a bigger divide in the country than we currently have. So my sense of it is, the last paragraph in my op-ed piece this week was, be rational, don't panic, don't do anything abrupt. It's too late to do that anyway, so don't do anything out of the norm that you ordinarily would not do. Stay in bounds, stay rational, and try to be as upbeat as possible, because you can have a lot of contagious things that could happen. And I candidly think if we're not at the bottom, we're awfully doggone close. And the people I've talked to, I did talk to the president of a bank early this morning about 8:30, which is not very early, but I talked to him. This is a guy that has a presence from Texas to Florida. They're comfortable with where they are. Very liquid, reserve ratios, all that's great, but they're comfortable that they feel in real estate it's probably, if not bottom, it's awfully doggone close. The downside of the market, there can't be a whole heck of a lot more. If the burn time goes like it's going the last 4 or 5 days, I think October 26th would be a great day to buy at zero if it continued to drop at 500 points a day. That's not going to happen. It's not fundamentally going to happen. There may still be some significant erosion down to whatever floor Susan suggested it probably will reach. But I'll leave it at that and tell you the Fed has thrown the kitchen sink. It's thrown everything it owns. I fundamentally think that there's not a safety net under our construction company. There's not somebody there saying, gosh, guys, can I help you make payroll today? Which we did. We'll see about next week, but we did find this week. You've got to have your fundamentals in place and be solid and be secure. And that includes without total subsidy supports.
Okay, we'll address the stock market. The stock market is the collective wisdom of all the people that are willing to put their money where their mouth is. And because it is the collective wisdom of everyone who's willing to put their money where their mouth is. It is right almost all the time. A lot of professional investors, a lot of individual investors are wrong the majority of the time. What we have happening in the last week or so is that the market is reacting to this credit crisis. Now, a credit crisis is a crisis of confidence. And part of what's happened is that you had the bailout bill passed, but over the weekend, after it got passed, you had a run of the banks going on in Europe, in Germany, in England, in Ireland, in Spain. This is why many of the European countries have had to come to the front and say, fine, we will guarantee all deposits in the bank regardless of size. They have a run of the bank going. Dave said the normal ratio of leverage for a bank is about 10 to 1. What that means is that a bank at any one point in time might have 10% of its deposits on hand. No bank can withstand a run on the bank, no matter how solid or how solvent it is. With that in respect, he also talked about the local banks being solvent. They may be solvent, but there are banks that have issues. And I will say this again, collective wisdom. If the stock market has driven the price of a bank stock down to single digits, the market is telling you that there are issues with that bank. The same way it warned us that there were issues with Wachovia. So there are Alabama banks that are trading down in single digits. I'm not saying they're going to go under, but the market is telling you that there are problems there. And all that needs to happen is you need to make sure that your assets are FDIC insured, that you're playing within the rules, that you don't have too much money. The bailout bill that was passed last week upped that coverage for the time being from $100,000 to $250,000. My expectation is that part of what the biggest problem right now, again, as I said, is a credit crisis. And a credit crisis is nobody wants to let capital go. Dr. Deravi said capitalism is based on capital. It has to flow. Right now, no capital has been flowing. That is the problem. There is a rate called the LIBOR rate. Y'all have probably heard a lot more about it in the last 2 weeks than you've ever heard about it before. The London Interbank Offered Rate. It is the rate at which banks loan to each other. And it has skyrocketed. And adjustable rate mortgages, loans to companies, all these things are based on that. The reason it's skyrocketed is banks aren't loaning to each other because they're scared. They know that there are too many other banks that are going to go under. They won't loan money to another bank. They typically loan money back and forth between banks all the time, and they're not doing it because they're scared about who is going to go under. And so that's the problem. They've got to get the LIBOR rate down. They've got to get the commercial paper markets unfrozen. The commercial paper, this is very short-term loans that companies, if a company needs to borrow money very short-term, like 30 or 90 days, they issue commercial paper. The commercial paper markets have been completely frozen. The Federal Reserve, as he said, is throwing the kitchen sink at it. Earlier this week, they took the unprecedented step of saying, we're going to buy commercial paper. And sure enough, last night, overnight, for the first time, we've seen some improvement in the commercial paper markets. This is why that's important. State governments, mainly a lot of companies, borrow money to help make payroll in the short run while they wait to get paid on accounts receivable. California last week warned the Fed that they might have to borrow $7 billion by the end of October, or otherwise teachers, hospital workers were not going to get paid. They typically get a huge part of what they get as a state government January, February, March, and April. And so they always borrow at the end of the year for the money that's going to come in the spring. They said today we may not need to borrow that money because the commercial paper markets are unfreezing. This is what I can tell you from my perspective. I would rather have Ben Bernanke in charge of the Fed than any Fed chairman that has ever been. His specialty was what caused the Great Depression and how to avoid it. I would rather have Hank Paulson in charge of the Treasury than anybody that has ever been. And because he comes to us as a chairman of Goldman Sachs, a whole lot of the problems that we're dealing with came out of the derivatives mess. If we had a Treasury Secretary that was a CEO of a major industry, they would be clueless. And so we are so fortunate to have these people. And Dr. Deravi criticized the bailout bill. I'll disagree in that could there have been a better bill? Absolutely. But in the past, what you have to, and when you look at banking crises, where banking crises have degenerated into a depression has been when governments failed to act. It is more important to act, to throw the kitchen sink, to do whatever and to keep doing whatever, to restore confidence and get capital flowing again than anything else that you can do. Better to have a bad bill than none at all. And what I found out that I didn't know was that buried in this bill was an option for the Treasury to basically be able to directly inject capital into the banks. I didn't read anything about that because I didn't read the 350-page bill that finally resulted. But that would never have passed politically. But that gave the Treasury Secretary the power that he needs to get this crisis of confidence. My expectation, so the reason the market has been in a free fall has been in the fact that you've got this run of the banks going, you've got this crisis of confidence, you've got no money flowing. And so the market hit a high a year ago of the Dow Jones at 14,000. I said all along, I pulled my clients out of the stock market in January, 95% of our money that was in the stock market, and went to short-term U.S. government bonds because I did see this coming. I sounded like a crazy lady for the first half of the year because I was saying major financial institutions were going to go under and we were going to be subject to the risk of a global market meltdown. And I hate to have been proven right, but this was foreseeable. And I said at that time that the best that would happen was that we would have a normal bear market. Well, a normal bear market would have taken the Dow down from 14,000 to 10,000. It's a 28% drop. Well, and we had a strong level of support at 10,000, which we blew right through because of the events of this week, because of the crisis in confidence. We had a level of support at 9,000 that should have held, and we blew right past it. I said all along that at worst, I thought the market would bottom at 7,500, but or 72 to 7,500, because that was the low point in 2002. You have a very strong level of support there. We're going to need an external event for that to happen. As long as we have the external event I'm going to describe in a second, I do believe that that external event will then prompt your institutions to come in and start buying. So I do believe that we are within 10% or so of what will probably be the bottom, as long as we get that external event. You have the G7 meeting this weekend. What I expect to come out of that at worst is for Britain and the United States to agree that they are going to guarantee all bank deposits with no limits for the time being. And more importantly, that they're going to agree to back all loans from banks to other banks. If they do that, that should drive the LIBOR rate down dramatically, which should release the credit, which should result in a huge bounce and a huge rally in the stock market. If the G7, they would like to get the G7 countries to all agree to do that. I don't know if we can get our friends in Germany, for example, to do that. So it'll be interesting to see what the weekend brings. But that's going to be a huge development that will be positive if we come forth and they can release the crisis of in the credit markets. That's going to allow the stock markets are forward-looking. They will bottom 6 months to 9 months before the economy bottoms. Last point is that if we get what I expect us to get out of Bernanke and Paulson, and we get the guarantee of all the deposits and a guarantee of all the bank loans, the LIBOR rate goes down, and we start to get a rally, you never, ever, in my experience, I'm a huge student of market history, get a V-shaped bottom, ever. What always happens is it looks like a W. Now, Wall Street calls it a retest of the prior lows. It looks like a W, okay? So don't be freaked out if we do experience a bottom in here. And then we run up, and in a month or two, we come right back down to this level. That is when the smart money, if that level holds then, that's when the smart big, huge money will buy in, and that's when the bull market will start. It always happens. You always have this retest. You always have this W. So don't be freaked out. That is your buying opportunity. That is your signal that the all clear is there. You want to see it hold that level, retest. You want to see then a cattle stampede of buying that comes back in. So if I was looking to buy, I might nibble if we get the results of the weekend that I think, but I would wait for serious money. I will move my clients' monies back in once we have a serious retest and then serious volume, a cattle stampede going back into the market at that standpoint. If they do not manage to resolve the credit crisis, if they do not take some actions, which I fully expect them to do, Katie bar the door. The next level of support on the Dow, if we blow through the 7,500 mark, is 4,000. And so, again, and the problems here that because we didn't hold at 10,000, we didn't hold at 9,000, is we have been in a free fall. Is that when prices, and we see it in the real estate market right now, people who normally would have said, ooh, that's a great price, I'm gonna go buy, or now that we're in such a free fall of real estate prices, are saying, I'm gonna step back and wait until I see some evidence that it's bottoming. And that's unfortunately what has happened with the stock market over the last week. You normally would have gotten institutional buyers stepping up to the plate at 10,000 and stepping up to the plate at 9,000, and it was in such a rapid free fall. Now they're saying, I'm just gonna sit back and wait and see what happens, which is why we need this external event to prompt them to come in at what would normally be this floor of 7,500. So the good news about all of this is that we're down 50%. That's creating huge, huge bargains, huge, huge buying opportunities, not only in the stock market, but in the fixed income markets as well. Preferred stocks, I wouldn't touch bank stocks or bank preferred stocks with a 10-foot pole. But other preferreds, when GE, AAA rated, has to pay 10% on a preferred, babies have gotten thrown out with the bathwater. That always happens. Huge, huge opportunities, huge monies are going to be able to be made as we get to the and we're closer to the end of this than we are to the beginning. And we're closer to the bottom than we are to the top. Okay. I think we need to open it up for questions, okay? June, would you, oh, well, no, I'll stand up here and do this. Do we have any questions? And you can direct it to the panel or you can direct it to any individual. Yes?
I guess this is a question to the panel or Dr. Deravi. I know you're in contact with Dr. Bronner, who holds our retirement system. What's the shape of our retirement system?
I don't. Can you hear me? I am not in contact with Dr. Bronner. Dr. Bronner is in contact with nobody. Totally be honest with you, he has a great staff. His staff is best educated and they're extremely, extremely equipped how to deal with this situation. But what we're dealing with here is a universal sort of tsunami. It's not, no one can be insulated from what's going on here. There was some discussion regarding what may happen, and he already raised the red flag and saying that, like everyone else, they may be down a substantial amount. While I understand and totally appreciate that his investments would perform like any other investment in this situation, and I totally understand and I appreciate and expect the market will return to some more optimistic levels. What makes me concerned is that the state of Alabama, its resources, have to make up for any differences that exist in the performance the retirement system is producing vis-a-vis the obligation. And what I call our mandatory contribution to the retirement system next year, when all these losses are declared, is going to be a monumental step that we have to take. And with limited resources coming into the state, more resources got to go to the mandatory before it goes to the children. I'm putting it in a very simple language. We have to pay the retirees, or we have to pay for the education of K through 12. That's what concerns me. It doesn't concern me that Dr. Bronner is upset or not. He will do okay in the long run, or we all crash and burn. I have every confidence in Dr. Bronner. He's a fantastic, shrewd businessman. And his staff, or some of our students, are fantastically well trained and they're equipped to deal with this. Again, I'm going to very quickly wrap it up for you. As I shared with you, ladies and gentlemen, we will weather this situation. This is a major correction. This is a major correction. The credit is a problem, capital is a problem, but we will overcome that. I'm like Susan. When I was young and innocent, I was studying what Bernanke was writing, and he's a fantastic economist. He knows what's going on. And what scares me the most is if he is doing what he's doing, and he is well aware of the shortcoming of what he's doing, it must be much deeper than we appreciate and we understand. For someone like Bernanke to go to the extent he's doing. Now, Paulson, Hank Paulson is a money manager in a sense, and he knows how the Wall Street works. If they look at tomorrow rather than next year. But Bernanke, again, it really concerns me that Bernanke thinks that he can fix and hold the prices of assets that have no value and high artificial value and hold it up there. So if he's doing that, he knows something that I don't know and I don't understand. Again, that's my major concern at this point in time. I hope I answered your question.
Other questions? Yes.
Susan, you said that if we blow through 7,000, the next threshold is 4,000 for the market if we don't have an external event. I wasn't quite clear about the G7 meeting this weekend. Would an example of an external event be a resolution by the G7 to support bank deposits?
Right. What I think they're trying to accomplish is they're hoping to get as many of the countries as possible to guarantee all bank deposits with no limits. Now, a lot of them have already done that.
Right.
But the key part, which was the LIBOR rate, would be for them to now take the next step and to guarantee all bank loans from one bank to the other. And so Britain and the U.S. are pretty much, from the Wall Street Journal this morning, are pretty much there in agreement. I don't think they're going to make an announcement today because they don't want to preempt or upstage the G7, but they're hoping to get some of the other G7 countries to step up to the plate and guarantee loans from one. If you could do that, you've had a number of huge money managers who've said, if somebody will just guarantee that, if somebody will guarantee what essentially is what they're calling counterparty risk, we'll step up to the plate and start buying, because then we're not worried about the fallout. One of the other things that's been happening that maybe has been pressing the market this week is today you have the resolution of all of the credit swap derivative reconciliation from the Lehman Brothers bankruptcy. I think that if they had it to do over again, they thought that they could let Lehman fail and take the consequences. There have been so many consequences, AIG is one of them, that have come out of that I don't know that they would let Lehman Brothers go under again. And part of what's also weighing in the markets is that there is the possibility that the markets again are telling us that there are issues with Morgan Stanley. And so you may very well see a government bailout of Morgan Stanley and maybe Goldman Sachs over the weekend. But Morgan Stanley is really a big weighing on the market. And there was one analyst on CNBC this morning that said that he thought that Morgan Stanley, maybe Goldman Sachs, would get nationalized over the weekend. So, but they realize we got to do something. We got to just keep doing it, whatever, until it works. Next question. Yes, ma'am.
Dr. Deravi, you have implied that, or at least that's the way I'm taking it, but the questions about what happens to the state, money is going to be tight regardless of the short term. Well, assume we get through the short term crisis and things stabilize. What do you see as fixes in the long run in terms of preventing this sort of thing, which obviously got out of hand,
what we're facing, again, ladies and gentlemen, is a structural break. This is not a normal cycle. Susan and I, we talked very briefly, and she wanted for me to mention it, and I just overlooked the fact. Usually a recession or a cycle starts either with consumers pulling back or businesses pulling back. It never started with a complete meltdown of credit. So no matter what we tell you folks, let me at least tell you my opinion. We are in totally uncharted territory. We don't know if this works or not. What happens is the Federal Reserve System, as Dave suggested, is a supplier of liquidity. Now, we hold as much as liquidity that Federal Reserve System can provide us, we hold it. Liquidity or money is a very special case. If you want to sell me Apple, I just have a certain amount. After a certain amount, I say no more. But if you want to give me liquidity, I hold it. Whether I pass it through or spending is a different issue. The issue is that liquidity is being injected in the market, in the financial system, but the banks, as Susan has suggested, are so insecure about the financial situation of someone else, they're saying, I'm going to hold on to see what's going on. Do we realize the moral hazard of what's going on here? First, we nationalize AIG, then we'll take over this and that, then we are guaranteeing the commercial papers. Now we are going to guaranteeing the interbank loans. Who's going to take care of my mortgage? Heck, I've been paying my mortgage. I want $100,000 of it being shaved. Someone give me a guarantee. If you give me $100,000 off my mortgage, man, I'm going to spend the heck out of that one. The point I'm trying to make for you is, I don't know how it's going to come up. I know, and I hope, and I pray, and I like for it to work out, and it will work out. I really believe in the ingenuity of this system and efficiency of this system.